Good morning. It is OPEC Day, Friday, December 7th, 2018, and the drama of the OPEC meeting this week is finally mostly over, and they have agreed on a 1.2 million barrel a day cut, which is about what I had expected, anywhere between 1 and 1.5. They kind of split the difference, which makes a lot of sense. These cuts should be viewed primarily as Saudi Arabia and Russia cutting, because there were several exemptions as to who would not have to cut. Several of the cuts by OPEC members and non-OPEC members are very, very small based on what we know of the Saudi cuts and the Russian cuts. Russia is said to be cutting their production by 250,000 barrels. That'll probably take them 2 or 3 months, so it will not be immediate. So that is 250,000 of the 400,000 from non-OPEC countries. And we know for a fact that Saudi Arabia was going to cut their production by about 600,000 to 700,000 barrels a day, 500,000 barrels a day that they're not going to be sending to the United States anymore. And we talked about that last week. So again, the vast majority of the cuts, probably 3/4 of the cuts, if 2/3 to 3/4 of the cuts are Saudi Arabia and Russia. And I think that's important because Saudi Arabia just continues to slowly soak up a little bit more and more market share. They are going to get some of their spare capacity back. So their spare capacity is about 2 million barrels a day when they're running normal. And they raised their production since spring by 1 million barrels a day. Now they'll probably cut by 700,000, give or take. And that still means that they're up 300,000 barrels a day from less than a year ago. I think people should keep that in mind when they think about oil investments and which oil investments are going to do well and which ones are not going to do well. Given that they just announced the Permian Basin is twice as big or has twice as much recoverable oil as they thought, the United States Geological Survey said that this week. And Saudi Arabia could always invest a little bit more money into their oil fields and bump their production up to 12 or 13 million barrels a day in a couple of years. That means that one group in the oil space is doomed, and I've talked about this before, and that's the deep water drillers. You want to stay as far away from them as possible because they will gradually go away. We know that companies like Volkswagen, who somebody is mentioning, and GM even at some point, and Ford at some point, and Tesla, with all the electric vehicles coming in the middle of the next decade, and they'll probably start selling really well by the end of the next decade, there is no space for deep water oil. This is why I describe the peak oil plateau. We're in it right now. We're just at the very low edge of the price range, which in fact was a little lower than I thought it could go. And maybe that was the last time we'll ever see 50-something barrel of oil. With the oil market tightening up, because the land drillers are able to keep up with demand, meaning that there's no permanent new supplies coming on offshore. And I say no, there will be some. There just won't be anywhere near as many deep water projects in future years as there was pre-2016. So the tightness in the oil market is here to stay. The traders, obviously, when there's not a lot of excess buyers in the market, can push the market around. They're doing it with tech stocks. They're doing it with energy stocks. And we talked about that several months ago, that the marginal buyer in the market disappeared because you have the Federal Reserve tightening up and the Chinese stopped investing in the U.S. markets about a year and a half ago. Now, if there's a trade deal and China decides, hey, there's some value in the United States again, after having done some cashing out here recently, I think that you'll see another rally if there's a deal with China. And if there's a trade deal with China, we could see just a monstrous rally in stocks. So that's very, very important. If there's just some sort of moderate, kick the can down the road, let's make this a election issue, let's bitch and moan about the Chinese, but not a lot happens. Tariffs don't go up, but there's not a lot of change in the structure that's always been there or has been there the last couple decades. Then it's hard to say. Then we probably just have a choppy market for a while. On the oil side, let's stick with oil for just a little while before we get into the broader market, and we'll really talk about the broader market next week. But on the oil side, there are some dynamics in the U.S. market that we just have to keep repeating until you understand it. U.S. refining can't handle pure light sweet crude. The vast majority of the refineries need heavy sour and Saudi medium crude to blend with the light sweet crude in order to make distillates out of it, gasoline primarily. What Canada and Saudi Arabia are about to do to us is cut the amount of heavy sour and medium crude to the United States by about 800,000 barrels per day. That would be about 500,000 from Saudi Arabia and the 325,000 that Canada announced as a reduction this week. I'm calling Justin Trudeau's revenge. I think that Trudeau likes nothing better than to needle President Trump at this point. And frankly, the Canadian oil industry is in a bit of disarray because they can't get a freaking pipeline built. And while I am a diehard environmentalist, the reality is, and anybody on the left needs to think about this, if we built the pipeline, the Keystone XL pipeline, which I was ambivalent about for a while, but I've come to realize we need that one last pipeline so that the Canadians can get their heavy sour to the Gulf of Mexico, to our refineries, so that we can blend it with light sweet. And here's why it's super important. If we do that, if we build Keystone XL, it's a major security issue, right? Because now we have no dependence on Middle Eastern oil at that point. We can get it all. We can get another 1 million barrels a day from Canada. They've got it up there, and we don't have a pipeline to get it down to the Gulf of Mexico. So for those of you who, and I know that millennial that I ripped on in a blog a while back, his project from a couple of years ago that he can't get published is about the Dakota Access Pipeline. And I understand, oh my God, a pipeline might leak here and there, but it's going to spill a whole lot less than trucks and trains because those are catastrophic when they happen. Train accidents. Trucks are just a nuisance and they cause pollution more than a pipeline ever would. We get that new pipeline. If we get the Keystone XL and they can find a route that makes sense, I'm not sure why they don't just run it in parallel all the way, but with the old XL, we have no need for Saudi oil at all at that point. And I think the day is coming when we don't need OPEC oil. Back in 2012 and 13, I talked about this on Market Watch, and I basically said that by 2019, the United States would be oil independent. Well, it came a little bit earlier than I thought mathematically, because this week last week we were a net exporter of oil products, right? And oil products. So we've been a net exporter of distillates, I think, since 2014 or 15. So it's been a while already. But now we're actually exporting more oil than we're importing. And we, as investors, need to keep an eye on the horizon, see if there's any legal changes, right? Democrats come in, they might change the law and say, yeah, you can export, but it has to be a swap, right? It has to math out as a swap. We might decide not to have any net exports until we are truly energy independent and for climate change reasons. Now, I'm not saying that's right or wrong. I'm just saying it might happen. So we have to keep an eye on what is the rhetoric in 2 years. But for the next 2 years, the oil companies in the United States should make a ton of money because this plunge in oil, I'm telling you, it was the last time it's going to happen for a very long time. because the land drillers, Saudi Arabia, Russia, and the United States, are going to be providing the new oil that needs to come into the market while the demand for oil is rising over the next decade. And the deep water drillers, because they know that the demand for oil will start falling about a decade from now, they're not getting financing for their projects. I take a look at a company like Exxon, which is bragging about all their oil finds off of Guyana. I have a friend who spent 2 years in Guyana. He knows the country inside and out. And I'll tell you what, they're going to drill some oil off of Guyana, but it's not going to be nearly as much as anybody thinks. Exxon has got major problems with dead assets that are going to just dry up and go away. Then I would run I just run from Exxon. Their balance sheet is not going to help them as they have mounting pressures from fewer and fewer assets. They did just buy Hess's assets in the Permian, which is not going to be enough to save them. But again, I tell you, there are oil plays that make sense and there are oil plays that do not make sense. If you own Exxon, you should be switching to a different dividend provider, ASAP. So with that in mind, let's talk about some of the oil stocks that we're in. And I've come up with a dirty dozen list. I'll show you 6 of them today. 6 of them are new, so those will go to subscribers over the weekend. And, you can take it from there. I do like building your own basket. Build your own Permian ETF, build your own oil ETF. By owning anywhere from 6 to a dozen oil stocks. I think owning a dozen mathematically makes a lot of sense. We know that about 12 or 13 stocks in a given sector, you're adequately diversified. Obviously, not against the sector, but from company risk. And I think that's what you should be looking for, is look for 11, 12, 13 companies to own in the oil space. With that said, here is your Exxon replacement. We have Occidental Petroleum, which is a huge supplier coming out of the Permian, and they just recently sold their export facility that's on the Gulf. So they put a lot of money in the building, and they flipped it. So ask yourself a question. Go back to what I just said a second ago. U.S. exports are probably not going to grow very much from here, given that our demand is rising as well. So our light sweet crude will get mixed with probably Canadian or Mexican oil to make the distillates that we need, the gasoline. Here we see that the money flow for Occidental fell, stock price fell. Money flows have leveled out and have started to drift up, and I don't know what today looks like, but I would imagine that's heading up. So it looks like we're at that inflection point. We're at that gentle rise for money flow into Occidental. I think it'll probably head back up into this zone, which means that the stock price should jump up. I expect fully a new high on Occidental Petroleum by sometime early next year, and I think it's going to break out of this range. It's going to go past $90 a barrel. I think, as I said last year, it will ultimately get into the hundreds. And in the meantime, you are collecting a dividend of 4.57%. They are buying back shares. And they are increasing their dividend. I want to show you them and Exxon over the last 5 years, right? About the same. Knock it down to 3 years. About the same. 1 year. Look at that gap that Occidental put in there, right? So on this dip, Occidental came all the way back down to where it was, but that's because Exxon just kind of chops along. I believe that this gap is going to open up again, and it's going to open up imminently. So comparing Exxon to Occidental, I'd say that Occidental probably has the better balance sheet because they have far less debt. They still have some assets that they can sell. Nobody's going to buy Exxon's assets. And I would think that the outperformance here, if you're looking at this as a pair trade, Exxon will chop along, maybe drift up with the higher oil prices a little bit short term, but Occidental is going to roar because they're much more leveraged to the cheap oil than Exxon is. Exxon has expensive oil, they have cheap oil, they're all over the place. XTO and Hess over in the Permian help them, excuse me, but not enough to offset the fact that Exxon is so diversified that you have to take the bad with the good. That includes Exxon's mediocre balance sheet that could become a bad balance sheet as assets get stranded in the next decade. So I would stay away from Exxon and I would buy Occidental. I understand why people would say, what about Chevron? They have better fundamentals than Exxon on balance sheet issues. But I think that Chevron's asset base is no better than Exxon's, and I think that they're going to have a problem in the future. What saves both of these companies long term is that eventually Exxon and Chevron are going to break into multiple companies. I believe that they will probably do kind of a clean, dirty split, and we'll see how they structure that. But wherever the top executives go, that's where you want to go. And I can almost guarantee that'll be the clean company that they develop 5, 6, 7, 8 years down the road. But I still think that Exxon and Chevron both, this is a decade out, but I still think Exxon and Chevron both could face bankruptcy 10, 15 years from now. So keep that in mind. Once the demand for oil starts to fall, the bigger companies will be hurt the most. Exxon and Chevron are among the biggest companies, and they're not doing much to transition right now. Total is one of the few companies that I would look at and say, okay, Total has a chance because of their alternative energy endeavors, and Royal Dutch Shell because they're almost exclusively focusing on natural gas, not exclusively, but they're heavily pushing into natural gas. That's their focus. I could see Royal Dutch Shell actually selling some of their oil assets down the road, but right now they're talking about being an acquirer, which I think is actually a bad idea for them, but it could be good for us because one of the companies that fit their profile to buy is Encana, which is a company that we own that I bought a whole bunch of calls on in the last week. So I think that Encana has bottomed out here. Historically, when they hit these levels for money flow, it goes up. And then you see up here, when money flow goes up, price goes up. So as money flows into the oil stocks, and eventually we'll get FOMO, people will start chasing these oil stocks at some point. They're going to really rally. I think they'll make back everything that they lost. I mean, this was a horrific sell-off. I did not sell. I just kind of held. And then down here, I started buying calls because I knew that this meeting, there was no way that they weren't going to do an oil cut. Every one of those countries in OPEC would have gone broke. So they need the price of oil to be in the 70s and 80s, and that is coming. Beyond petroleum, yeah. BP is not really beyond petroleum, are they? They're practically becoming more and more of a Gulf of Mexico play again. Interestingly, so somebody mentioned British Petroleum, BP, in the chat section. This is a real low money flow number. Prices already came down. This is a pivot point. Start to go up. This will start to go up. I still think Encana is a pretty good bet to get into the 20s in the next couple of years, right? So long as we don't have a major recession. And, on that note, even if we raise tariffs on China and they fight back, I don't see a major recession. Maybe a garden variety recession in the next year or two. But the whole crash 2020 thing, I tell you what, the fundamentals of the economy are way stronger than I thought. This correction that we just had really improved valuations around the globe. And we should be looking around the globe for some investments at some point. But I think the potential surprises on the trade front are more likely to be positive than negative. I think Lighthouser's job is to cut a deal. That's why they didn't send Navarro. The last couple times that he went out there, he cut deals. And I think we'll get the marginal improvements that I've talked about for months and months and months on trade. They won't be pound your chest, brag about them, improvements in trade. I mean, they will get bragged about, and Trump will pound his chest, but they're just going to be marginal little improvements. Um, you're going to see China buy some natural gas from us. They're going to solidify their agriculture purchases from us. They're starting to want to protect IP technology or technology IP as well, because China's been filing more patents than anybody. So why wouldn't they want to protect those? And I still say that in the second half of next year, you're going to see the petrodollar take a knock. Why is that? Because once the pipelines to the Permian Basin come online, the United States will have very little need for the OPEC oil, especially if we can get more oil from Canada and Mexico, which at some point somebody's going to build a freaking pipe to get that done. But Saudi Arabia lowering their exports to the United States might be a permanent thing. I showed the chart last week from the EIA. Take a look at last week's video if you haven't seen it. But there's every reason to believe that Saudi Arabian oil to the U.S. is going to be down around 500,000, 600,000, 700,000 barrels a day forever, for a really long time. I don't think you see the Saudi Arabians doing President Trump any more favors. What do they care? He's only got 2 years left, maybe less. Given everything that's going on, unless this economy booms, historically speaking, Trump really doesn't have a chance to win, given what his approval numbers are, and given that there's a pretty offended portion of the population, and he's really maxed out the number of people that he can get out to vote. So I think it's very unlikely that President Trump is the president again. But if he is, then we have to rethink what that scenario leads to. At that point, he's emboldened, right? And if President Trump would win again, I think he's emboldened. I think he goes after a lot of things hardcore. And at that point, I'm scared. Right now, I trust the rest of the world leaders to try to wait him out. And again, I say wait him out because I just think that he's bungling a lot of things. But not to the point to create a financial crisis. And all these people, like, I won't mention names, but you got people who are bubble people, right? Talk about bubbles. They've been talking about bubbles forever. You know what? If you keep talking about bubbles, bubble this, bubble that, bubble the other thing, everything bubble, this bubble, that bubble, the other bubble, eventually something happens, right? The clock hits midnight every day. So I'm not horrified by the economy. I'm not horrified by global debt because there's twice as much money supporting it. So even though we have as much debt as we had before, there's twice as much money in the world. And I think that we can look at the numbers and say, okay, if we look at all the numbers together rather than just picking out a snapshot here, a snapshot there to make a scary chart, the reality is that the global economy is slowly improving. It's been slowly improving for a decade. It's going to keep slowly improving. There will probably be some speed bumps. There will be a garden variety recession. And then the central banks will come in and say, okay, well, we need X trillions of dollars to keep this from getting worse, right? That's the way it goes. And unless the idiots really get a hold of all the central banks, then I think we're going to be fine. I mean, even Jerome Powell, even though he wants to normalize because he doesn't understand slow growth forever, he doesn't understand why demographics are driving what they're driving. He doesn't understand the impact of technology to be disinflationary. He doesn't understand that the debt overhang, while it's not catastrophic at this point, could become catastrophic if we don't tighten up a little bit. And the United States is definitely flirting with catastrophic, given that we're going to run a $1.5 trillion deficit next year to give $1 trillion of those dollars to the 1%, which will not trickle down. It will not help most of us. That could become a problem. But in the very short term, the big issue that we're going to have to face is when that last baby boomer gets on Medicare. And it's not because Medicare is a bad program. It's because we are stupid about how we fund these things, about how we do healthcare in America in general. So at some point, we have to correct all that, and it'll be a shock to the system. How does that impact oil? Super slowdowns in the economy impact oil, right? So I don't see any of those super slowdowns soon, but those are things on the horizon that we have to keep an eye on. So the last baby boomer was 1964. Add 65 years of that, that's 2029. Last baby boomer hits Medicare 2029, right? So, by the end of the next decade, we have to keep an eye on that. Global growth can be stoked with infrastructure spending, with transition to alternative energy. I think you're going to see a massive change in the 2020s to the power grid. The electric vehicles will be outselling internal combustion engine vehicles by about 2030, maybe sooner, but probably 2030 because that's what the laws look like that are changing. And, until then, oil and supply and demand just remain tight, right? We're going to have this tight period, this peak oil plateau. I've shown the charts. And that's going to mean that certain companies that are leveraged to profitable oil, that have good balance sheets, that have takeaway, good rock, the whole thing, good rock. That's what they call having a good oil field, good rock. They're going to do really well. In the United States, where are most of those companies? They're in the Permian Basin. Not all of them, but most of them. And I think you're going to see quite a rally from these stocks. And Conda's up 2.78% today. Centennial Development, which also I think is a big takeover target. Again, coming off oversold. They don't have numbers for this yet. Let's see if I can get year to date. So year to date, because these are a newer company. Again, inflection points. Look at how low these are. This is an inflection point. Money's going to start flowing in. Let me chop along, start going up gradually. Then as these prices come up, as these moving averages turn the other way, then you get the FOMO people. Oh, it's a new trend. You got to jump on that. They're going to miss from 15 to 19, right? But they might carry us up well past the new highs or the old highs. And I think that's true. I think we go from 15 to 30 on this one, probably in the next year or two. Great Permian position. And he's basically built this company to be taken over. So this Pappas, old EOG guy, right? EOG. And, very low debt, right? Not a low debt company. They just started producing huge growth. They're going to have huge growth. They're going to be a bolt-on piece to somebody else. Somebody else is going to come and buy these guys around 30, be my guess. And Kana, I think somebody comes along and buys them around 20-ish. Continental Resources, interesting company, not Permian. They're in the Stack Scoop in Oklahoma, which is prolific, but it's Oklahoma, so you worry about the earthquakes. They got to really control that. Even though they're not right in the earthquake zone, they're close enough. But then they're in the Bakken. So here, I'm going to talk about a company that we have owned. These guys are not on my Dirty Dozen list. This is very speculative with Chesapeake. But Chesapeake just merged with Newfield, and I like that merger. Why? Because it gives them a Bakken assets that they can sell. Continental is in a position to buy the Bakken assets from Chesapeake Energy. So are a couple of ConocoPhillips would also be a good bidder because they're in the Bakken, and then a handful of other companies. Whiting Petroleum theoretically should be a bidder, but they won't be. I think they have a problem in Colorado. I think that the Niobrara is going to continue to see stops and starts with what they're allowed to do out there. Colorado is not going to let them do whatever they want. So even though they turned down Prop 112, there's, they have the State House now there in the governorship. There's going to be some controls. And that's another thing that's going to weigh on the whole oil narrative of supply and demand is that you are going to have more and more states and some countries, but states in the United States where they're controlled by the Democrats, and they're going to put major controls on the oil and gas drillers. And those controls will probably look something like this. And when I say this, I'm not making this up. I've talked to some, Democrat operatives. The rules that are going to be put in place in certain states are basically going to say, look, you can drill, but these are the requirements, and you're going to put money into an alternative energy fund and a cleanup fund. So the marginal cost of drilling in places like Colorado are going to go up. And in New Mexico, which is flaring off the most methane in the Permian, you can expect major controls on methane coming by the early 2020s. So at some point, you have these tightening factors on oil and gas, oil supply. Right now, we're swimming in gas. They're actually giving away gas in the Permian. Somebody actually paid a quarter per million BTUs to get it hauled away. So once the pipes for gas are coming out of the Permian in the next couple of years, and you can expect KMI, Kinder Morgan, to be one of those companies, there's going to be a lot of gas flowing out of there. And our natural gas exports are really the thing that should ramp up, not so much our oil exports. So Continental Resources, look at that. Big inflows. Why? Because people expected the increase in the price of oil from an OPEC agreement. So they started buying in about the time I did. They took their lumps like I did. And now it's going back up. So what do we know? When money flow falls, price follows down. When money flow goes up, price follows up. Look where we are. It's up 5% today. It's going to keep on going. It's going to set new highs. All of these companies, I believe, will set new highs. Pioneer, again, remember, Continental, not Permian, right? Bakken and Stack Scoop, which are the next two best plays. But these guys don't hedge, right? They don't hedge much. So until we get to about $80 oil, give or take, on Brent and 70-something on WTI, these guys are going to keep going up. When the ceiling gets hit, hopefully Harold Hamm is smart enough to start hedging his production. And if he does, then they can hold it. But their biggest gain is going to be during the period while oil is rising, and then shortly after. And then they'll be done. That's when they'll take your profits. Pioneer, just about done converting to a pure Permian play, which means that they could also become a takeover target, even though they are $17 billion, $24 billion market cap. Still could be a takeover target. At $30 billion. Yeah, you can see Exxon making a desperation play to get these guys to add to their XTO and their Hess positions. Now imagine what we see if Exxon does acquire a company like Pioneer or some of the other companies that are on my list. Centennial Development, right? And then there's another one that I'm adding this weekend. Some of you already know who it is because you work with me privately. This is a stock that could break into its all-time highs. So let's take a look at their 5-year chart. Look at where these guys were. All the way up to 30. I think they did sniff 230. I could see this one going all the way up to 230. Now, will it bust through here? Will it bust through these levels? I don't know, right? I don't know. How's that for a great answer? But I think it'll get in that range. Why? Again, all of these Permian companies and Continental are making money in the 50s on oil. So as oil gets into the 60s and 70s, They're just dropping money to the bottom line. They're buying back shares, most of them. I don't know if Continental is. They're adding dividends. Pioneer just added a dividend, right? They have a forward-looking dividend now. So you can expect these companies to keep returning cash to shareholders, and that's really what you're looking for in the oil space. You're looking for companies that can afford to return money to shareholders. Why is that important? Because we are at the beginning of the end of the oil age. So by the end of the oil age, these companies have to just be spitting out cash, hand over fist, as they try to figure out what their next iteration is. And what a lot of these companies will become, as oil demand drops from 100-some million barrels a day to probably 50 million barrels a day by the middle of the century, is they'll just become legacy producers. They'll have very low capex. They'll just be draining what they've already got drilled. Maybe they'll have a rig here and there. But by the middle of this century, you should expect oil demand to be cut in half. And these companies are going to have to adjust. So the companies that are debt-free, right? These guys have low debt. The companies that end up debt-free sooner than later are the ones that survive, and they're the ones that can keep returning cash to you. So that's what you need to look at. Who's debt-free? Who's going to be debt-free soonest, right? Continental has some work to do. That's why they're a trade. Centennial Development, nice. Occidental, right? Pretty good, right? They're going to get that paid down too. Then you have Enbridge. Enbridge, if you're looking for another dividend payer, right? C Corp, don't have to worry about the K1. Money was drifting into them, kind of fell off, probably go back up. And this one just has kind of a steady flow. Here's the thing. They're in a position now with their new pipeline coming on in the Permian that they're actually going to be able to increase their dividend payout. Their dividend payout will be high enough and gradually increasing, right? As their dividend increases, they'll drag the price up. Not going to be a super sexy stock, but it should go from 30-ish to around 50-ish over a couple of years. That's a double, right? When you figure in that you're getting around a 6% dividend. So if you are a legitimate dividend growth investor, not a pretend dividend growth investor, not a fake dividend growth investor, right? If you're actually looking for the growth part of dividend growth, Enbridge is going to be one of those companies. Now, they're also the second biggest natural gas pipeline company in the country behind KMI. So I do like Enbridge a lot. They are in all of my dividend portfolios now. Kinder Morgan, I talked about doubling from these prices, getting up towards 30. They're taking their sweet time to do it. They still have debt to pay down, but they're, basically them and Enbridge kind of tied. Depends who numbers you look at, but they're 1-2 or 2-1 in natural gas. And Kinder Morgan's going to have more natural gas pipelines in the Permian soon, late next year. I think it's late next year. There are like 10 pipelines I've been keeping track of. And that'll help them pay down their debt, help them continue to double their dividend from what they wanted to do with it. And, this will end up being about a 6% yielder. As that dividend goes up, price should drag up. There is a lot of bad feelings about Kinder Morgan from former Kinder Morgan investors. I think that as they see this company start to succeed even more, I think a lot of them come back. But, they have this stupid phrase for I got kindered. It went from 16 to 7 or 10 or whatever it went down to. I got kindered. No, you didn't get kindered. You got Saudi'd. The Saudis did this. Kinder Morgan had nothing to do with this. Kinder Morgan didn't cause a whole bunch of companies to go bankrupt and void their contracts. Kinder Morgan didn't cause Chesapeake to have to renegotiate with them. Right? They got screwed like everybody else. They didn't screw anybody. They probably had too much debt because they expected there to be this big natural gas boom. And I think there will be a big natural gas boom. I was talking about it back in here. And I'll tell you what, it hasn't come yet. It will. When? I don't know, next year or two. And what if there is that China deal, right? What if China says, we'll take X amount of natural gas? Then these guys are going to get this pipeline up and running next year sometime, take that gas to the Gulf, send it out through Cheniere or somebody else, and bam, all of a sudden you got a price that's running. Will it ever see its highs again? I don't know about that, but I think that's where it can head towards. Probably not break through, but head towards. But we'll see. We'll see how those natural gas dynamics. There's a lot more upside than there is downside, right? Chopping along a couple years, a lot of upside. Again, not in my dirty dozen because I wanted to focus on oil plays, and these guys are really part of the natural gas equation. So other companies that I would throw out there, I will mention them by name. I'm not going to talk much about them. So we're far enough in that if people want to watch us on YouTube, this will be their reward. Another company that I think that you could take a look at for dividends. Great balance sheet. This dividend is going to grow. They're going to buy back some shares. And again, Marathon Oil, low debt. You want it. Okay, not exactly a Permian play, not a Permian play at all, and a little bit more diversified internationally. So this is some international diversification for that basket. Another company that might get bought out. Permian pure play. Here. Another company, look at the debt, kind of low, like that low debt. Money flow. See all these companies starting to turn up. What does that mean? Oversold, troughed, money flow starting to come in. If you think you're a value buyer, a value investor, if you ever claim to be a value investor and you're not buying these oil stocks right now, you're not really a value investor. You're just a guesser. So you want to be a value investor, then you need to start buying these oil stocks now. Who else do we got? Big guys. Devon Energy. That's not quite as low as you want, but it's pretty low, and it's going to zero at some point. They're buying back shares. They're increasing their dividend. One of the big Permian players. Diamondback, Permian player, clearly could get bought out. Low debt. Like it. Oversold. Look at the jump. Look at the jump. What's going to happen next? Bammo. Right? So there's certain stocks here that I would swing trade over the next year or so, maybe two. But most of these stocks I do want to own a couple of years. Like I said, going into the next recession, and I'm becoming less convinced that a recession is coming unless the Fed and Trump cause it. If they don't cause a recession, we're not going to get one, not for a while. And if we do, it'll be garden variety. Europe is gonna keep doing what they have to do to keep things afloat. China needs to keep growing. India's got all the right things in place. All these people who talk about all the bad things on the planet, they're just freaking wrong. I understand if you don't like the way that President Trump acts. I understand if you think he's a thief. I understand if you think he's a retard. And I know that that's not politically correct, but I did use it properly. If you think he's slow, well, then so be it. I don't think he's a smart guy, but who cares? The fact is that if he doesn't screw up, and hopefully Mnuchin and Kudlow and a couple other people have some influence on him. I think Lighthouse, whatever his name is a pragmatist. Navarro is the only one that I wish would just disappear. And given that President Trump has this relationship with Prince bin Salman, hey, maybe somebody will disappear. We'll see. Hey, there you go. Too soon. Let's see. Who else do we have? And then we have Targa. These guys. These guys. 7 going on 8% dividend. They got whacked. Whacked a couple weeks ago. And I think that's going to all come right back. Now, how do I feel about them long term? They're just another pipeline company. It'll drift up, but this is one that I think you can swing trade. You know, you're going to have your dividend investors piling in because, oh, look at that dividend. It's great dividend. I'm going to buy that stock because of the dividend. Really, it's a swing trade because as the stock price goes up, the dividend yield goes down, and then you have to evaluate it going forward. Targa probably ought to just get bought at some point, so you could even maybe hold it through that. Permian pipelines, it would make sense. There's already discussions about mergers in the Permian right now. So Marathon Petroleum is talking about merging some of their pipeline plans with Exxon and somebody else's. Targa would make sense to get bought by somebody. It's the right price, so I could see these guys getting bought because they don't really have growth opportunities anywhere else. So I think they're just a bolt-on piece. Is there a big premium there? Probably not. Teeny tiny premium. They're going to have to do it just because they have to do it. And then this dividend gets folded into whoever else. It'll be lower. So I just like the swing trade here. I think if you want to trade something, and this might not right now. It's on my dirty dozen list. I think it's probably going to swap it with EOG. I do just see this one as a swing trade, but it's a pretty good swing trade. I mean, from 40s to the 50s. I mean, you see 20-30% move here in the next several months. Just starting to turn up after troughing, oversold. I mean, a lot of these are pretty darn good moves. So waiting to happen. So I would just take a look at those. All right, we're closing in on an hour. What kind of questions? I like the chat. Talk about Trump. Somebody goes, I like him. Somebody else says, I hate him. That's the whole point. Makes a market, right? The guys that in Canada are buying shares. A lot of insiders at the oil companies buying shares. So all you gotta do is look online and you can see that. Well, Occidental was down more than Exxon recently, but they had been opening up that big gap. I'm telling you, you were gonna kick yourself for owning Exxon for using up valuable portfolio space on Exxon. You were gonna kick yourself. Tomorrow's Exxon is not what yesterday's Exxon was. Does VW's announcement that they're moving towards electric vehicles by 2026? No, we already knew they were doing hybrids and electrics soon. My whole thesis has been that electric vehicles will be selling more than gasoline vehicles by the end of the next decade. So that's right in line with that, right? Right in line. CRC. I don't mention California Resources Corp because I don't cover them. I never talk about this company. You guys have brought these guys up. You guys have brought this company up a couple times. I'm not excited about this company. I remember taking a look at their asset base. Just not sexy to me. I don't even know what that means. Are these guys completely debt-free? If they're completely debt-free, I guess that would be a reason to take a look at them. Oh, they're not debt-free. I don't know what's attractive about these guys. I really don't. Buy quality on corrections. I don't think these guys are quality. I think it's a junk company looking for a rebound. I was positive that's the conclusion I came to. I had to look at it again, but I'm not going to look at it again if you want to. If you want to prove to me that it's a good idea, that's fine. I have been buying ECA 2020 Leaps. Always try to get the bid, even though you might have to buy at the ask. I told you what I think of ECA. I think it's going to the 20s eventually. I did take a look at Murphy Oil. I don't like that they're a little bit more diversified with their plays. They're okay. I don't love them. I think Devon's on the list. Yeah, absolutely. You want to look for companies with good rock and low debt. And if they have assets that aren't real good, that somebody wants those assets as a bolt-on piece, right? Like I said, Encana picking up that Bakken asset, or excuse me, Chesapeake picking up that Bakken asset, it's something they're going to be able to sell. I actually think that Chesapeake, as a matter of percentages, probably has the most upside. I think they're one of the only ones that could quadruple or quintuple. I mean, I think Chesapeake could get over 10. You know, and from under $3, I mean, that's a triple. You know, what if it gets to 15? Right? So, USO, I'm still in it. I bought calls in the non-qualified accounts because I use interactive brokers and they restrict retail people from buying calls. See, interactive has a couple of weird things. I use interactive brokers and I have to use the leveraged ETFs rather than using selling options in an IRA. And it doesn't really make sense because what's more risky? You know, the algebra on these things are just brutal. Now, granted, it's up 12% today or whatever, but look at that. The compounding effect, right, is just freaking horrible. What we need to hope for those of us who are underwater 50%, because I'm underwater 50% on this trade, so I had 10% of my portfolio go down to 5. I need for this to get to, well, mid 30s. I'll be even. So price of oil today. Somebody quick look at WTI. What is WTI right now? 53. So I need about a straight line 18% increase in WTI just get back to even. So 53 times 1.2, let's just say 1.2. Yeah. So I need the price of WTI oil to get into the low to middle 60s just to be freaking even on this trade. Now, but I did, like I said, I bought some more calls in Encana and some more oil stocks. So I have huge leverage there. As the price of oil gets towards 70, I'm just going to get out of this position, right? Unless there's a crisis, unless there's a war, unless there's some reason why we think we're going to get a spike to 100. But I just playing the actual price of oil will become less attractive at some point. I think we can get our money back. I don't even think that's in question. I think we'll get our money back. And then, you know, as it gets to 70, we'll make a profit. It's just not going to be the double or tripler that we thought it was going to be. It's just going to be a normal return. But then we get the cash back to do other things. So I'm not too worried about it. I know that people freak out because they're down 50%. But remember what Buffett said. If you can't be down 50%, you shouldn't be an equity investor. But we did trade this poorly. There's just no freaking doubt about it. We traded this poorly. You know, I told people in here to get out of it. I gave three prices to get out, basically 70, 80, and 90. I think my 70, 81, and 90, something like that. So folks ought to have been 100% out, right? If you owned it up here and from here to here, that's pretty much on you. This part of the drop is on you because you didn't sell in here when I said to sell. But from here to here, Hey, that's an ass kicking that we took together. That was a good night out at the bars. Found an alley, and some big guys kicked our ass. So, hopefully this is it. Now we get this big run up. We need to get WTI to the low to middle 60s, and we're all whole. And then you right size the positions, and you want to keep a little bit to ride up. Go ahead and do that. Right now, I own a whole bunch of USO calls. I own the $12 calls to July. Didn't go any longer than that. I didn't want to pay for the time value. I can always roll them. But, price of oil gets back up into here. Get this up to around 15 because it doesn't compound the same way as a triple leverage. Get up to 15, turn my calls, which were under $1, into $3. I get a tripler in 6 months. I can live with that. All right. Yeah, 53.78 on WTI. Yeah. Venom. I studied Venom last night too. First time in a while. Here's the problem. So Diamondback Energy still owns them. These guys have not converted to a C corp yet, so there's still a K1 to worry about. I do like the mineral rights here, right? But with Diamondback owning a ton of the shares, you might as well just own Diamondback, right? Just own Diamondback until these guys are further down the road in separating that company. The insiders got in on it. I didn't check to see if they sold, but now it's back down here. Does this get back towards 40? Probably, but I think the Diamondback does better. Remember, they're paying a whole bunch of that dividend to Diamondback. So, I don't want to deal with the K1. If you have a non-qualified account and you're a dividend investor and you want to have a basket of these types of companies, it could be in there with Targa and Enbridge and Kinder Morgan. Definitely, if you want to own a half a dozen of them, for somewhere between 6 and 12% of a portfolio, if you're really a dividend income investor, that's fine. You'll get a rally. But as it gets up here, you really have to think about, do I want to keep holding on to it as that, your effective yield will be higher. But you got to remember, as this yield goes lower, new investors are less likely to come, right? Because people go, oh, look at the dividend, look at the dividend, look at the dividend. So they forget about the growth aspect. You need to be aware of the growth aspect. So can it get back up into here? For sure. Will Diamondback do better? Probably. In fact, let's take a look at Diamondback compared to this. Okay, let's take a look. FANG, right? And then let's look at the total return price, right? Because again, account for the dividend. Just go max, normalize it. Look at that. What's the point? What's the point? I think Diamondback probably outperforms them, and I don't have to deal with the K1. Now, if K1 doesn't bother you, go ahead and buy them both. Make this in a basket with about a half a dozen total pipeline companies. And I will tell you, be careful with the pipeline companies. Certain ones aren't going to do very well because they're locked. At this point, they don't have growth. You're just playing them on a swing trade for a rebound like Targa, or for a takeout Targa. But I think Enbridge, because of their natural gas position, Kinder Morgan, because of their natural gas position, are the two to really own. Williams, I think you could take a look at. Let's put them on this chart. Yeah, Williams just sucked. So let's give them their own. Right? Williams has been all over the place. I was investing in these guys way back here. We had a really good rally with them one time. I can't remember why they keep falling off the map. I know one of them had to do with deregulation. So what is this going to do? I would imagine that Williams is probably going to see another run up as the natural gas boom takes hold, and they've people that tried to buy Williams already. So, I think this would be one of your aggressive picks if you had a basket. All right. What else we got? All right. BCEI. No idea who that is. Bonanza Creek Energy. Dun, 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 dun. No, is that the right song? Is that the right song? I don't know. Dun, 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 dun. Yeah, I think it's the right song. All right. I have no idea who these guys are. None. I don't like that chart at all. No debt. Interesting. Have to do a deep dive, see what the heck they're worth. I have no idea. Rocky Mountain. Don't like it. Don't like the Rocky Mountains. Niobrara, Rocky Mountains, don't like them at all. I'm telling you, those Rocky Mountain ones are the ones that have a problem for the oil producers. All right, have a great weekend. Stay oily.